So we got a few things to talk about with regard to inflation. It's both good news and bad news. So the first thing we're going to do is we're going to cover some potentially bad news about inflation, or some potential news that makes us want to take a pause and suggesting that that's it, inflation is over and we're in the clear. We don't want to be in the mindset that inflation is for sure over. Remember, the big danger that we face in the market right now is believing that inflation is done. There's no way inflation can rise again, and we're back to the moon. And there's always the risk that inflation pops back up. And in the event that inflation starts trending back up again, we're going to be in not a very happy stock market, dare I say. And what I think is remarkable is that while this risk of inflation remaining somewhat sticky exists, we're actually noticing that bond yields are remaining very sticky, which is actually quite bad for real estate. In order for the real estate market to really get a floor placed under it in terms of the pain that we're about to see in the real estate market, where we're going to get those year-over-year comparisons showing negative real estate appreciation, which I expect will create substantial fear in the real estate market, I believe us sticking around 3.5% for 10-year treasuries is bad for real estate. I believe we need to get to about 2.5% on the 10-year treasury. Unfortunately, quantitative tightening contributes to the 10-year sticking around 3.5%. But also, I think as inflation goes away and you start seeing inflation recede, you should have more people moving into taking advantage of these bond yields at 3.5%, and you should see the yields fall. But because they're not falling, it's a sign that even the bond market is still uncertain that inflation for sure is going to fall. This is despite the fact that the bond market is pricing in rate cuts from the Federal Reserve at the end of the year. So you definitely have a very tentative market, I would call it. And there's a reason the market is tentative when it comes to inflation. Here's a piece from Bloomberg that suggests there are no disinflation signs yet in Jerome Powell's preferred price gauge. And that this is the price gauge of basically core services excluding rents. And even though inflation on PCE is undershooting the Fed's summary of economic projections, when we look at core services inflation, we're still stuck at about 0.4%, which is the same as where we were last month. And on an annualized 1, 3, and 6 month basis, we're still stuck at core services around 5%. And this is not good, especially the super core level, which is where you take away what you have for housing services ex inflation, right? And so this chart right here shows us PCE core services ex inflation, and it shows us still relatively high inflation. Is stuck in this sort of core services segment. And this is creating some pain or some ammunition, that is, for Jerome Powell at the Federal Reserve to potentially say, hey, you know what? When it's time for his press conference, he might end up referring to exactly this measure, this core services inflation measure, and suggesting, hey, look, core services are still running hot. We're going to stay higher for longer. I actually think the Federal Reserve is going to have to do exactly that. They don't want to talk inflation, or they don't want to sort of talk up markets and reiterate what markets are seeing, which is this idea that, hey, inflation's going away, inflation's not the problem anymore. Instead, what's the problem is an aggressive Fed. I don't think the Fed wants to do that, because if the Fed does that, we potentially reiterate a market rally, and we potentially lead people to spend more money on services, which leads to more services inflation, and then inflation comes back, which actually would likely induce a harsher Federal Reserve reaction with maybe truly higher rates. Maybe the concern that rates could end up running to 6% becomes a reality if inflation ends up popping up again, or core inflation, core services inflation continues to stay high. In order to keep massaging this down, you have to make sure people stop spending money as much as they are. And the more people keep spending money, the more that level stays up. People spend more money when they feel wealthier. when they feel that real estate prices are going to start moving up again, or stock prices are going to start rallying again, start spending money more loosely again. Usually, at least according to Robert Schiller from Princeton, famous economist who has put together things like the Case-Shiller Index for real estate, he suggests that it's actually house prices that lead to the biggest boost in core services inflation. So it's really when people feel like they're becoming poorer because home prices are coming down, that is generally when you're going to really start seeing that deflationary hit to spending and then core services. And so I believe the Fed is going to have pretty much have this pretty harsh face on for probably at least the next 3 to 4 months. Whether or not they actually raise rates each of those months, I think the important thing is them, whether they pause or not, being very clear that we're staying here at least until we're certain that core services inflation is going down, especially ex-housing, because we do think housing is going to plummet. Housing inflation will plummet. That has to obviously happen, which if it doesn't, that'd be a big problem. But we think with leading indicators such as current rents versus old owner equivalent rents, that will end up happening, and housing will end up being a big anchor to inflation coming up. We have to see that come through. But in the meantime, I think probably it's too premature to be excited about this idea that the Fed is going to be really nice to us on February 1st, which is their next FOMC meeting press conference day. Now, there's a lot of talk about this CPI change in how the federal or how the Bureau of Labor Statistics or the CPI release is calculated. So there's a CPI weighting, and there's a little warning on the CPI website at the Bureau of Labor Statistics that says, starting with January 2023, data the BLS plans to use will be updated with weights using annual weights based on a single calendar year rather than using expense data from 2 years, which is the usual way they do it. Now, a lot of folks think, that's it, here we go. This is the Bureau of Labor Statistics rigging data again. And maybe that's true. But I personally believe the reason that they are wanting to use 2021 weights rather than 2020 and 2021 weights as sort of an average is probably because of the oddity of a year that 2020 was. Right? 2020 was really COVID and lockdown year, and I believe that's probably why you're expecting the BLS to use weights just from 2021 instead of 2020. And the weight changes could end up being relatively nominal, so we'll see. When the next CPI report comes out, we will find out, okay, hey, what were the weight changes, right? And then we can a little bit more break down, hey, how much of an impact did these weight changes actually have? Personally, I don't think they're going to have a dramatic impact, but mark your calendar for February 14th, and we'll see what impact these weight changes have had. Again, this is not saying we're not going to compare to 2020, we're not going to compare to 2021 in terms of pricing. It's just to say that, because we're not, right? We're really only comparing to 2022. It's just to say that what consumers spend their money on is going to be looked at from the perspective of 2021 spending rather than 2020 when we were in lockdown era, which lockdown era could overweight, let's say, home services rather than restaurants and air travel and going out services. So we'll see what kind of impact that ends up having. But I think it's too soon to say that, here we go, the CPI is for sure going to be rigged. Now, we do have some more good news, but also bad news when it comes to inflation. I started with bad news, so I think for a brief moment, I'll continue with bad news. We've already talked about how Johnson & Johnson and Procter & Gamble, staples providers, are still seeing high inflation, and the impacts of high inflation are expected to be felt in their earnings for at least the next 5 months, really basically through the first half of 2023. That's actually a bad thing, right? We don't want to see that staples or companies that are producing our, shampoo or deodorants or whatever, or still suffering from high inflation, whether that's freight costs or commodity prices. And even though those commodity prices have come down, they're still seeing year-over-year pain in inflation. That's not good. We don't want more inflationary indicators. And Johnson & Johnson and Procter & Gamble are really telling us they don't expect to see inflation start subsiding until the second half of 2023. Now, it's entirely possible that by the time we get to the second half of 2023, we're going to be in an environment of deflation, potentially rapid deflation. Certainly, we're already seeing that in the autos market. And there was actually a post this morning that I saw showing price cuts for certain BMWs. Yeah, here it is. South Bay this was the car dealership guy. This is the faceless guy who actually provides pretty good information on cars or on Twitter. I have not verified this, but anytime I've verified any of his other information, it's been pretty right on the money. So I'm going to go ahead and go with it here. He indicated that BMW started dropping prices. At least here's a South Bay BMW report showing that there's a South Bay BMW clearance sale going on, and that all new and in-stock i4s, Series 3, Series 4, Series 5, Series 7, Series 8, X3s, and X5s are all receiving price cuts ranging between $3,500 and $10,000. Probably the average price cut here is about $4,000 to $5,000. So it's interesting to start seeing price cuts occur at some of the competitors to Tesla's. And I think that's actually quite deflationary, and I expect we're going to see a lot more of that. But in the meantime, we do have a little bit more bad news to cover, and then I want to get to some good news on inflation, and that is what 3M just said in their earnings call. So 3M, look, I'm the biggest fan of earnings calls, and we continue to read earnings calls on a daily basis to try to study what's going on in the world. We believe that earnings calls are some of the most underutilized, yet best tools for understanding what's going on. For example, in the Tesla earnings call, we actually believe that Tesla alluded to future price cuts coming, but did so by dodging a question about whether or not future price cuts would come, but reiterated that future price cuts would actually come via their margin pressure comments, that gross vehicle margins would probably decline to about 20% for Teslas, and then eventually trend back to 30% over time. That means the worst of margin pressures isn't actually built in yet to Tesla. This is something that I think the market is somewhat forgetting, is that, yes, the margins were not as bad for Q4, but this is what I said, right? I said this going into Q4 like 27 times. I said, look, most of the price cuts occurred in Q1 or at the end of Q4 with vehicle credits. You're not actually going to see the real margin damage to Tesla until 2023 in Q1 in that vehicle report, right? That could end up being the worst for Tesla. But I think markets are rallying now for Tesla because they see that the demand for Teslas is still there. And even if they do cut the price of this vehicle, because they're now recognizing FSD revenue, their earnings per share actually has the propensity of growing quite substantially as Tesla recognizes FSD revenue and more people start taking FSD. That's the big question. This is one thing to recognize revenue for stuff you've already sold. It's another thing to actually continue to sell and push FSD. Anyway, let me get into this 3M earnings call. So the 3M earnings call gave us both green flags and red flags. I'll start a little bit with some of the red flags. And unfortunately, 3M, much like Procter & Gamble and Johnson & Johnson, which these are staples, right? These are our like industrial staples, I like to call them. When they see inflation, you know, a lot of people are seeing inflation, right? They expect inflationary pressures to remain also for the first half of 2023. So now you have three big companies saying that: Johnson & Johnson, Procter & Gamble, and 3M. They're also seeing slower than expected growth due to rapid declines in consumer-facing markets, such as consumer electronics and retail. And they say that dynamic actually accelerated in December as consumers sharply cut discretionary spending and retailers adjusted inventory levels. Now that actually, on one hand, is actually deflationary, right? Taiwan Semiconductors actually came out in response to this and said, hey, look, even though we expect fewer smartphone sales, more smartphones today are actually using more semiconductors, and so Taiwan Semiconductors thinks they could be somewhat insulated to reduce smartphone sales in that each new smartphone has more semiconductors in it. I thought that was very interesting. Don't get me wrong, Taiwan Semiconductors is still seeing reduced demand as other companies are, but I find that very interesting that, yeah, the more advanced products get, the more chips they end up using. China has COVID-related impacts. Healthcare continued to be challenged in its recovery. A fall off in disposable respirator demand and our exit from operations in Russia. Respirator demand, not a surprise to see a big decline there. Everybody was buying construction respirators for COVID initially. Inflation continues to impact raw material, logistics, and energy costs. The pressure remains persistent, and the pressures are broad-based. I believe that people at the Federal Reserve are either asking Jerome Powell to read this, Jerome Powell's either reading my videos or watching my videos, or staff at the Federal Reserve is passing this kind of stuff on to people at the Fed. And it's not good when you have 3M just now. They just released this, right? This is on January 24th. They just stated that inflation continues to remain persistent for them, the pressures of this. That's a red flag, right? And so this is another reiteration that, unfortunately, the Fed's probably going to have to be tight for longer. Now, 3M says they address inflation through price actions. Well, price actions are really a way of saying that we're going to raise prices. But the problem with price actions is price actions don't necessarily mean you can pass on all your inflationary costs. And I found this very interesting. I actually highlighted this right here specifically. So I'm going to read this and I want to translate it. The key question for us that we have to think through, and that's what we are thinking through, is as deflation starts showing up in the economy, the discussion that we're going to come up with is the elasticity of price, not just across our company, but across all companies. We found that over time, the company that drives value to the customer can end up having a good price equation. Now, I paraphrase that slightly because this person stumbled over this miserably. So I'm going to now translate this in English. Deflation is likely coming in the second half to input costs and output products within the industry. Output products are stuff you buy. Input costs are stuff they use to make stuff. And deflation is likely coming. Now, 3M expects to still be profitable, but it sounds like they still expect to be less profitable. In other words, they expect to be in the green, which is their word, but have lower pricing power and lower margins. So this is really remarkable because now you have a situation where you actually have the following. You have United Airlines talking about potentially competing on price with the other airlines. That was just in their last earnings report. You have Winnebago talking about potentially competing with their competitors on price. You have Johnson & Johnson talking about deflation coming in the second half. You have Procter & Gamble talking about deflation coming in the second half, or at least, reducing inflationary price pressures. So I'll call it disinflation for Johnson & Johnson and Procter & Gamble. And now you have 3M saying, what's it going to look like when we start going into a deflationary environment? While everything is not yet good, it is clearly, very, very clearly evident and in our face that we are probably going to go into a disinflationary environment and then soon hit deflation. Now, the problem with that is it's not going to happen fast. And that's what I keep trying to convey in my videos, is that we are not going to get, in my opinion, a V-shaped recovery. The days of a Larry Kudlow V-shaped recovery are over. Instead, what we're seeing is in January of 2020, everyone is like, holy hell, inflation is terrible. We're kind of over here, let's say, and markets are still to fall. Everyone in their earnings call is like, inflation is so bad, we're all raising prices, everyone's raising prices. There was so much unanimousness. And people wonder, like, Kevin, what was your catalyst? They still wonder to this day for selling in January of 2023. And it was the combination of all of the earnings calls that I was reading, combined with the Federal Reserve going, oh, damn, we've effed up. They didn't exactly say that, but they basically said that. You could still see my reaction to the Fed going, oh, damn, we effed up. By looking up a video, Meet Kevin, worst report ever, Federal Reserve on YouTube, you find it. It was from January of 2022. It's actually like, I think, a history lesson to go back, not because of what I said, because I'm not trying to pat myself on the back here, but because of what the Fed said. And it was combined with all these crazy earnings calls. Now we don't have the catalyst for a V-shaped recovery, because what are the earnings calls telling us? They're telling us slow recovery. That's what all the earnings calls are telling us. They're telling us still seeing some inflation, slow recovery. There's no indication, though, that things are hellish to where we would expect a black swan event. Don't get me wrong. A black swan event could happen. You could have some kind of insane dislocation in the bond market where markets suddenly crash and some insanity occurs. And stocks could just suddenly break substantially lower, and then the Fed has to come in and bail out markets and save the day. But there is a high likelihood, in my opinion, I would say a 90% chance. Okay, this is my opinion. I'm going on all in here, okay, so I could be wrong. But I believe there's a 90% chance that we actually end up having the Nike swoosh style recovery, where stocks just continue to recover, and there will be volatile days. Stocks will go down again. I don't know from what level they will go down again, but they will go down again. There will be red weeks, and there'll be hellish times, and there'll be fearful. There will always be red again. But I think on net, unless we have some kind of massive capitulation because of some kind of black swan event, I think the Fed's going to keep this aggressive face on, and markets are going to slowly, very, very slowly trend back up again. We just broke, for the first time, the downtrend by breaking the 200-day moving average on the QQQ and the SPY. If you're watching video rather than the audio podcast, you could see that here. If you're just listening, it's simple. Because now, obviously, after I do these live streams, I'm posting these to Apple Podcasts, Google Podcasts, Spotify, so that way you could listen to these when it's convenient for you. But we've broken the 200-day moving average, and we've really begun what could be the beginning of a slow uptrend. Now, I want you to keep in mind that if we go back to the old days of the uptrend, after the V-shaped recovery of Larry Kudlow, we basically had 2 years of an uptrend. We still had dips, though. It was a rocky way up, but it was a consistent up. It was higher lows and higher highs. We potentially could start that trend again now. And that's very exciting to me. Now, there's also some more good news, and it has to do with Chipotle. Chipotle Mexican Grill actually just gave us some very interesting insight regarding hiring and jobs, which is probably one of the most important parts when it comes to what the Federal Reserve is looking at. The Federal Reserve right now is suggesting that they need to force joblessness to prevent the most deadly, financially deadly aspect of inflation, which is a wage price spiral. And Chipotle just came out and announced that they are hiring 15,000 individuals across America, which is an increase of about 15% of their 100,000 current workforce. That actually sounds inflationary. That sounds bad, right? Coupled with Walmart raising wages. But we've already talked about how Walmart raising wages is really them catching up, and they are probably lagging far behind because they're losing money, and they're very sad that they have to raise prices for their employees to keep them. But Chipotle actually gave us some good news. They said the following, quote, "It's been getting easier to keep hourly staff, with December being one of the company's best months in years for retention rates," says Chipotle's chief restaurant officer. "Easier to hire entry-level workers now that retail demand is softening, and tech companies, such as Amazon, are laying off workers. The workforce is migrating back to leisure and hospitality, increasing applicant flow. Now, Chipotle is trying to double its footprint of restaurants across the country, and this is potentially the best opportunity for them to do so." All right, so let's try to understand that for a moment. Chipotle is basically telling us the wage pressures are going away. More people are finally coming out applying for entry-level jobs, which reduces the risk of a wage price spiral. This is good because this is what happens in a recession. People look for work, and the few companies that are actually expanding are the ones that can really set themselves up for massive success in the future. I'm not trying to, again, pat myself on the back, but I myself, and I don't know if this will play out well, it's obviously a massive risk, but I have taken on more spending and more business building for my own businesses, whether that's the YouTube business or the courses we sell and providing more value within them, or the real estate startup that I have, or the financial business that I have. We're putting more effort into these than ever before. And it's because I believe that the time to invest is in a recession. And then when your competitors don't invest in a recession because they're giving up and they're throwing in the towel and they're bored, or they're just not winning the way they used to and they're sad or whatever, or they're afraid to spend money in a recession, I believe I have a massive competitive advantage by spending. And so I personally relate to a company like Chipotle on obviously a substantially smaller scale in that now's probably the best time to expand because nobody else is. And this actually sort of reiterates what we're seeing with what the Bank of Canada told us the other day, which is that higher rates take a while to hit services inflation. And even though services inflation is remaining relatively sticky, it is likely to come down in the second half of the year. And so far, that's what everything is pointing at. Procter & Gamble, Johnson & Johnson, Winnebago, United, 3M, Chipotle, they're all singing the same song. Yes, prices are still higher today than they used to be. Yes, there's still some persistent pressures, but it looks like by the second half of 2023, they're going to be gone. And then we're going to be dealing with deflation as a greater risk. And when we deal with deflation, guess what the Federal Reserve does? They print money, baby. They print money. You don't have to look far to understand that the Federal Reserve prints money when we face deflation. The European Central Bank and Deutsche Bundesbank have been regularly referring back to the times of fighting deflation with printing money. There was actually a piece, I can't recall if it was in the Wall Street Journal. No, it was in the Financial Times. That's where it was. There was a Financial Times piece where a member of the Deutsche Bundesbank just a couple days ago was talking about how, look, when we face deflation, we print money. That's just what we do. Now, whether you think that's good or not, or sustainable or not, doesn't so much matter. It matters what in practice occurs. And in practice, that's what they do. So I find that very entertaining to pay attention to. Because it's going to be so weird that when in the future we're back to money printing, and in a few years we look back and go, "Was? How are we back to money printing? This is incredible." I actually found it here. This is the Deutsche Bundesbank Financial Times. Here it is. The article is entitled, "Interested in China." Oh, sorry, that's an ad. Opinion, Eurozone inflation. Eurozone can beat inflation while keeping markets stable. It's by Sabine Maderer, which kind of sounds like murderer. That doesn't sound too good. But anyway, a few years ago when inflation was stubbornly low, despite a series of interest rate cuts, central banks were expanding their toolkit to lift inflation. This resulted in asset purchases in trillions of euros. This was written like a few days ago, okay? This is not like forgotten. The Fed knows that when they need to print money again, they will be back to printing money. It's kind of remarkable to think about, but it's coming. It's coming, and the signs are very, very clear. I think it's funny and I've really stopped caring. Like 2022, I cared too much, way too much. It was a very difficult year psychologically for me. I'm in a way better place now. Head state-wise, it's great. It's important, especially as a creator. I think you have to go through those sort of phases or struggles, and then learning to advance. But anyway, I'm in a much better place now, which I'm happy for. But I look at sometimes I'll post a video and go, "Here's good news on inflation," and then I post a video and I go, "Here's bad news about inflation." And if you actually watch the videos, you see I'm actually painting a very consistent portrait. I'm saying I don't believe that on net we're going to have a big capitulation. I think there's a lower chance of that, and I think we're going to have a Nike swoosh style recovery where it's slow and steady, and you want to be invested in the market because you're not going to get the big Fed U-turn that's like a bat signal. It's just not going to come this time. And that's why I've been invested in the market. Now, I think I invested in the market too early, and we can complain about my personal moves and decisions all day long. I don't think anybody's perfect, but I think the message that I'm sending is very consistent. But unfortunately, there are a lot of people who don't actually listen and take a step back and look at the full portrait that we're painting, and they just look at titles and they're like, yesterday you said inflation was good, today you're saying it's bad. This is like flip-flop 127. And I actually think what's quite fascinating about my channel is if you go back and look at all the videos, not suggesting that you do, but if you go back and you look at all the videos since January of 2022, I've been pretty dang consistent with the trajectory. And I don't maintain that consistency for the purpose of saying, oh, I'm consistent. I do that because the data has been clear. You know, the data has been very, very Nike swooshes that things are getting worse. Okay, now we're starting to see changes, and they're very slow and gradual. It's these very slow and gradual changes that make sort of this portrait that we're in now, which I think reiterates the Nike swoosh. Quick down, a stock market crash that fell 3 times as fast as the dot-com bubble, no necessary massive capitulation point, VIX stays low. Why? Because we're Nike swooshing. I get the question all the time, Kevin, why is the VIX so low? Why is the VIX so low? Because we're Nike swooshing. I don't know if it'll stay that way, but that's a belief that I have. It's also interesting that Americans are actually working fewer hours right now. Americans aged 25 to 39 are pulling back on work. The top earning 10% of men in the U.S. logged 77 fewer hours in 2022 compared to 2019. Now, I don't know what to make of that. I think that in some sense has a little bit of a disinflationary push to it, because if people work less hours, then you actually suggest that there's less demand for their labor, and that is disinflationary, right?
Compared to a 0.2 decline last month. So.
All right. So one of the notes in the actual report shows us here at the bottom that within goods, the decrease in PCE was widespread. So this is good. Within goods, decreases were widespread. We want to hear that, right? We want widespread decreases in prices, led by gasoline as well as motor vehicles and parts. Thanks, Tesla. Within services, the largest contributors to the increase were spending for housing, transportation, mainly air transportation, and healthcare. Now again, we expect housing to plummet. As long as it does, we should be okay. Put that in the wrong spot. There we go. Air transportation. Now this is fascinating because we do continue to see pain in air transportation, and this actually brings me to a report on Southwest, which gives us some more insight into some of the actual inflationary impulses that we're still seeing at the airlines. And we've been studying the airlines here not as a potential investment, but more as sort of an indicator of what inflation could be doing going forward. Southwest has new 737 MAXs, which fortunately are more fuel efficient. However, there's the expectation that China's reopening could end up pressuring ticket prices. And the assumption right now is that if fuel prices stay stable, we're still going to be putting more pressure on flying. And given that the entire industry is still smaller than what it was in 2019, in other words, it's smaller today than what it was in 2019, pilot costs are expected to continue to go up. Salaries in the airline industries are expected to continue to rise. For pilots, pilot salaries could rise as much as 18% as soon as early this year, potentially another 5% by the end of the year, according to research by Bloomberg. Fares are expected to need to rise from today 19 to 27% just to get to 2019 levels of profitability. That's insane. Think about that. Prices still have to go up 19 to 20% on airfares just to get to 2019 profitability. Now, that doesn't mean prices are actually going to rise 19 to 27% because they might not have the power to do that. Consider, for example, what United Airlines said in their earnings call. They said that if our competitors start cutting prices, we are prepared to cut prices as well because we think we're more efficient. That does not mean you're going to get back to 2019 profitability, and guess what you have more of today than ever before? Debt. In my opinion, that makes the airline industry a terrible investment, but it certainly continues to increase the inflationary dynamic and concern that we have. And if you couple with that Chinese reopening, there's concern that we're going to continue to see inflation, at least in the air transportation sector, which apparently was one of the leaders in inflation for PCE in the report that just came out this morning. Now, there is a suggestion that by a lot of institutions and hedge funds, and I think it's nonsense, but a lot of institutions and hedge funds are calling for $100 oil upon the Chinese reopening. I personally don't see it, but it's possible. Brent's sitting at 88.42 right now. It's been slowly sneaking up. But one of the things that I think is quite interesting is what you saw when China shut down and Russia invaded Ukraine is you saw Russian oil, instead of going as much to China because of the COVID pandemic and their lockdowns, their 3 years of lockdowns, and also a removal of Russian oil from other parts of the world, like the United States or otherwise, what you actually interestingly saw was you saw a substantial amount of Russian oil go, guess what? To India. A lot of Russian oil, while it's still flowing to China, went straight to India this year. And you could see that on this particular chart here. While this orange level is expected to rise because this is all representative of a Chinese lockdown era, what you actually have is right after the invasion, the other parts of the world, such as Europe and the United States, saw the purchases of Russian oil almost disappear to nothing. Whereas you have India's purchases of Russian oil skyrocket and basically more than absorb. You could see that more than absorb over here, more than absorb available oil from Russia. Now, what I think is remarkable about that is, guess what kind of companies are starting to all of a sudden dump a lot of money into investing in India? Well, you happen to have one of the largest companies in the world, which happens to be an American company, and it happens to be a company that probably 50% of you are watching me on right now. It's Apple, folks. Apple. Apple wants to see 25% of their manufacturing in India in the future. They expect to have 25% of their products manufactured in India. And guess who's taken maybe not all, but a ton, literally millions of barrels of oil, hundreds of millions, quite frankly, when you add it all up. Who's taking it all? India. So it's kind of interesting. As Europe and the United States, on one hand, say, oh, we're going to make sure Russia pays, and we're going to stop buying their oil, and we're going to put price caps on. Fine, put price caps on. That creates shortages of oil and increases the cost of oil for us in America. But what does it also do? Creates an arbitrage opportunity where countries like India can buy the oil cheaper. And so now you actually have potentially cheaper domestic production in India. And what companies are taking advantage of it? Oh, American companies that are swooping in to take advantage of a cheaper cost of production. It's pretty weird when you think about geopolitics and how on one hand you have to politically show, oh, we're going to punish Russia. But on the other hand, American companies are hopping in to benefit from exactly that. It's expected that India could be getting somewhere between a $25 to $40 arbitrage on the cost of oil. Cheap oil, kind of fascinating. Now, this, by the way, is also expected to impact the, or be impacted by Chinese reopening, because as India has started taking so much of Russian oil, if China does reopen as strongly as expected, now all of a sudden that Russian oil might not be eaten up by Chinese reopening, creating again shortages. Because now what was otherwise displaced by other countries is getting eaten up by India. So an interesting potential thesis that, yes, maybe it is possible oil could still take up to that $100 range. Personally, again, I don't think so. I'm not a big believer that oil prices are going to run. I think we'll end up relatively stable. And if anything, we might trend down. But that is a big trade that's being done right now, or being made right now. Do keep in mind as well that China itself is expecting some substantial investments, not only into the real estate sector, but also the auto sector. And it's worth considering that for a moment. Right now, and all of this, by the way, contributes to the Chinese reinflationary boom. The first number that you have to remember is that China's discretionary savings is sitting at about $700 billion. That's about third the size of what the American discretionary savings were. And when you look at that on a per person basis, it's even more wild, given that India has about 1.4 billion individuals. You're really only looking at about $500 of savings, whereas Americans had about 12 times that, or about $6,000 of savings, contributing to that inflationary nightmare. So the per person increase, the per capita increase in sort of available cash is not that high in China relative to what we saw during the U.S. boom, if you will. But in aggregates, hey, $700 billion of a potential built-up savings rate or amount is still quite a bit, and it still has that potential for driving some form of inflation, especially since China is now providing guarantees to their developers to help them finally get the real estate industry moving back again. Chinese cities and towns make a lot of their money from property auctions, so they're very incentivized to keep the real estate market going. We've seen an 18% decline in sales from January to November of 2022. However, that's only down at about a 6% decline if you go year over year, January to January, and that's because in December and January you've seen a lot more support for the real estate market in China, which could also be inflationary again. It's easier for real estate companies to issue bonds now because some of the debt is being guaranteed, or the performance of developers is being guaranteed, making Chinese bond debt for real estate companies less risky. That potentially means, okay, great, less of a crazy housing crash, but then it also potentially means, are we going to go back to that speculative real estate bubble that we had in China, where Chinese developers are building ghost cities, literally cities with high rises and no one living there, because the thought of, if we build it, they will come, wasn't actually true. So you had a lot of developers building properties that didn't end up actually being sold or rented to anyone. So there is that risk of creating another bubble environment. And if you create another real estate bubble in China, you're going to have some more real estate induced inflation, especially as more real estate development increases the cost of concrete, it increases the cost of iron, increases the cost of copper, which as commodity prices go up, what happens? We have supply-induced inflation, which eventually ends up showing in consumer price numbers. So there is a claim to the idea that China is going to be inflationary. Again, I think because of my rubber band scrunchy analogy that supply chains have become so much more resilient, we probably won't have as much inflation as individuals are expecting. But China doesn't want to be held back. And so they are doing everything in their power, the Chinese Communist Party, to make sure they continue to invest, such as the likelihood that China is potentially going to become the world's number 2 exporter of vehicles, surpassing both South Korea and the United States, and certainly Japan as well. These are all pretty substantial exporters of vehicles. And you've got companies like Polestar being manufactured by Volvo and getting investments from the Chinese parent company Geely, really hoping to take advantage of the Chinese export market. Though cars exported by China are a lot less expensive than cars produced by companies like Polestar or even Tesla. China is really known for its cheap cars. It usually exports cars about 30% cheaper than their Japanese counterparts. Cars tend to be exported at an average price of just $13,700. China right now exports about 2.5 million passenger vehicles, but get this, they expect that to grow to 8 million vehicles by 2030. That is 3.2 times the export vehicle market for China by 2030. Now, personally, I actually think that is a big positive for a company like Tesla. You want the winds at your back in China. You don't want China saying, Tesla's American, let's put a lid on them. China wants to do whatever they can to ensure they can get as many vehicles out of China as possible. They are encouraging exports, building more railways, expanding ports as much as possible. And a strengthening US dollar, a weakening US dollar could actually be good for companies that, like American companies like Tesla, that export vehicles from China to other areas, but also Keep in mind, only about 45% of revenue for Tesla comes from the United States. So a weakening dollar is going to increase the value of that 55% international revenue, which is great. Okay, so this is interesting, right? So when it comes to inflationary impulses, you have oil concerns. You do have the real estate concern of China. You've got this blowing up, expanding car market in China. You've got inflationary concerns from the airlines, but you've also got inflationary concerns from staples. I hate to say it, but the other day I reported that Procter & Gamble was showing us some pretty concerning inflationary trends. And that kind of slaps us in the face of thinking that, oh yeah, we're definitely going to see deflation, right? I mean, take a look at this. This is Procter & Gamble. This was one of the most critical portions of the report. On the commodity side, we've seen some of our commodities annualized, as you say, shown some decreases. That's great. But the majority of our commodity basket still sees week over week and month over month increases. So they're still seeing pain from inflationary pressures at Procter & Gamble. And I was hoping to get a different story from Johnson & Johnson. Johnson & Johnson, obviously another staples provider. But unfortunately, what we got at Johnson & Johnson was not that. We actually got more warnings about inflation. In fact, Johnson & Johnson told us that in consumer health, they expect to continue to utilize strategic price increases across the portfolio to reduce inflationary demands. You have comments that inflationary pressures are affecting almost all of their cost of goods sold, that their operating margin is expected to be flat, driven by inflationary pressures. Again, that they're expecting to increase prices in certain areas. They do expect that inflation will be better in the second half of the year, but not in the first half of the year, which echoes what we've seen some of the inflationary complaints at Procter & Gamble. Again, they don't expect deflationary relief until the second half, and if anything, they're expecting a worse inflationary impact in the first half. So you have some inflationary concerns. It's not like I don't want to be the person that's saying you're only expecting to see deflation. No, there is still a large inflationary catalyst, and it's sitting in the following areas. It's sitting in airfares. It's sitting in healthcare, which is literally what the PCE report this morning reiterated. The PCE report that just came out 20 minutes ago from the time of this recording. Within services, the largest contributors to the increases were spending for housing, transportation, mainly air transport, and healthcare. So Procter & Gamble and Johnson & Johnson are telling us, yep, still seeing that inflationary impulse at least for the first half of the year. So you do have some red flags for inflation. You've got the China concern, the oil concern, the China concern being broken into two parts, autos and sort of their expansionary investments leading to not necessarily higher average selling prices for cars, but a higher demand for commodities. And you got a housing sector that potentially could boom again in China, leading to, again, more pressure on commodities. And you have, again, airlines complaining about increases in inflationary pressures, from pilot pay to just regular wage pay in the job sector for airfares. But then also, you have Johnson & Johnson, Procter & Gamble telling us staples are still seeing inflationary pressures, and those are likely to continue for at least the next 6 months. So everything is not great. Yes, we have a lot of disinflationary impulses. The average price of vehicles coming down substantially. Chip sector, prices coming down substantially. Goods generally deflating across the board. Commodities have come down about 20% year over year. But it's reports like this that unfortunately are going to send a signal to the United States that, and the Federal Reserve, that maybe, just maybe, we've got to keep some pressure on markets, because there are still what I call inflationary embers. And that's a problem. Inflationary embers mean higher rates for longer. Higher rates for longer potentially mean more pain in the stock market for longer. However, and fortunately, following the PCE report that just came in about 20 minutes ago, the stock market has slowly started to trend higher. Maybe just maybe, the stock market is willing to look past the next 6 months of inflationary impulses that may still exist and the embers. Because remember, even Procter & Gamble and Johnson & Johnson told us we just basically have to get through the next 6 months of inflationary impulses. That's good. And the Fed is also aware that it takes time for higher interest rates to really affect every part of the market. So potentially the light is at the end of the tunnel, even for the staples and commodities. That would be great. But obviously we'll be paying attention to China in the meantime.